We've spent weeks dissecting the brutal truth behind the SpaceX secondary market myth to see if a $50,000 entry point is a genius move or a death sentence. We're pulling back the curtain on why valuations defy logic and how investors get locked into positions they can never sell. This is the dark side of the space race they don't want you to see. To evaluate a prediction this bold, we have to understand three things in depth: who Ron Barron is and why his opinion carries real weight, the specific numbers and business units driving his forecast, and the honest obstacles that could keep those forecasts from materializing on the timeline he is projecting. Let us go through all three. Who Ron Barron is, and why this is not just another bull call. Ron Barron founded Barron Capital in 1982 with $10 million under management. Today, his firm manages approximately $55 billion across multiple investment funds. His investment style is deliberately unfashionable by Wall Street standards. Identify exceptional businesses led by exceptional people. Invest early at reasonable valuations and hold for years or decades, not quarters, not months. His track record on Elon Musk's companies is genuinely remarkable. Barron began investing in Tesla between 2014 and 2016, ultimately committing $400 million. He has disclosed publicly on CNBC that Barron Capital has now made approximately $8 billion in profit from Tesla alone, a 20 times return on that original capital, delivered while Tesla was simultaneously the most shorted stock in the market and one of the most widely ridiculed investments in financial media. While every analyst who called Tesla overvalued got the headlines, Barron held, and the math proved him right over and over again. In 2017, when SpaceX was privately valued at approximately $20 billion, Barron started building his position. He increased that stake through multiple subsequent private funding rounds, eventually amassing over $1.7 billion of invested capital in the company. By the time the IPO occurred on June 12, 2026, those holdings had generated over $13 billion in unrealized gains. At the IPO, Barron Capital's total SpaceX holdings were worth approximately $15 billion, representing roughly 27% of his entire $55 billion fund. And immediately after the IPO, he added another $1 billion in shares. He then stated publicly, "I think we are going to make hundreds of billions of dollars. Not millions. Hundreds of billions." This is the conviction level of someone who has already made billions in this specific company, who has read the prospectus with granular attention, and who is now putting even more of his own firm's money behind the call. That does not make him right, but it does make him worth listening to with full attention. The prediction in detail. The math behind $500,000 to $1.5 million. Let us break down exactly what Barron is projecting and how he arrives at the 10 to 30 times return scenario over 10 years. At the time of Barron's prediction, SpaceX had completed its IPO at $135 per share, raising approximately $85.7 billion in the largest U.S. IPO on record. The company's post-IPO market capitalization reached approximately $2.3 trillion. From that valuation, a 10 times return puts SpaceX at $23 trillion within the decade. A 30 times return puts it at nearly $70 trillion. These are numbers so large they almost require a second reading. For context, the current S&P 500, representing the 500 largest publicly traded companies in the United States, has a combined market cap of approximately $45 trillion. Barron is projecting that SpaceX alone in 10 years becomes worth more than half of the entire current U.S. stock market. That is the scale of the bet. For an individual investor, the math works like this. A $50,000 investment at the $135 IPO price purchases approximately 370 shares. At a 10 times return on the overall company valuation, those shares would be worth approximately $500,000. At 20 times, $1 million. At 30 times, the upper end of Barron's projection, approximately $1.5 million in 10 years, from $50,000. That is the headline number, and it is extraordinary by any investment standard. The Starlink thesis, the real engine behind Barron's bull case. Barron is unusually specific about where he believes the bulk of SpaceX's value creation will come from. And it is not the rockets, not the Mars missions, And not even the AI division grabbing all the recent headlines. It is Starlink. Here is where Starlink stands right now. As of early 2026, Starlink has surpassed 10 million active subscribers across more than 160 countries and territories. The connectivity segment generated approximately $11.4 billion in revenue in 2025, representing 61% of SpaceX's total revenue and accounting for its only profitable operating division. Starlink is the sole unit generating positive operating income, roughly $4.4 billion in profit in 2025, while SpaceX's rocket launch division lost $657 million and the AI division posted a deficit of $6.35 billion. Starlink is growing at a pace that is difficult to fully absorb. The company was adding roughly 750,000 to 1.5 million new subscribers per month as of the IPO period. The subscriber base went from 1 million in 2022 to over 10 million by early 2026, a tenfold increase in 4 years. Revenue is growing proportionally, approximately $7.7 billion in 2024, $11.4 billion in 2025, and projected to reach somewhere between $15 and $24 billion in 2026, depending on the analyst model used. On CNBC on June 16th, just 4 days after the IPO, Barron called Starlink the Internet for the entire planet and stated that SpaceX is now planning a constellation of up to 100,000 satellites to meet what he describes as essentially unlimited global demand for data connectivity. His specific 10-year projection for Starlink: 300 million subscribers generating $1 trillion in annual revenue, with earnings before interest, taxes, depreciation, and amortization in the range of $700 to $800 billion. At the kind of valuation multiples that a high-margin recurring revenue subscription business at that scale might attract, Barron values Starlink alone at approximately $14 trillion. Let us put that in perspective. $14 trillion for Starlink, one division of one company, would be roughly 3 times the current market cap of Apple, the most valuable company in the world today. If Barron is even directionally correct about a fraction of that trajectory, the implications for SpaceX's overall valuation are enormous. The competitive moat. Why Starlink is ahead and how far ahead it actually is. One of the most important questions any investor should ask about a high-growth company is, what stops someone else from doing this better? In Starlink's case, the honest answer is that the barriers to replication are among the highest in the technology industry, and SpaceX's lead is almost certainly larger than most people realize. Starlink currently operates a constellation of over 10,200 satellites in low Earth orbit. SpaceX currently holds approximately 82% of the global commercial launch market, which means it is also uniquely positioned to deploy and maintain its own satellite network at costs that competitors cannot match. The cost per Falcon 9 launch after reusability has dropped to the $20 to $30 million range. Competitors launching satellites on equivalent vehicles pay $40 million or more. This structural cost advantage is not a temporary edge. It is baked into the physics and economics of reusable rocketry, which SpaceX pioneered and which nobody has replicated at comparable scale. The competitive landscape is real and worth acknowledging honestly. Amazon's Project Kuiper has deployed over 300 satellites and is targeting a constellation of roughly 7,700. Blue Origin plans approximately 5,400 satellites beginning in late 2027. China's Guowang state-backed constellation is expanding, and SpaceX's own prospectus named more than 20 direct competitors. But none of these competitors combine launch capability, manufacturing scale, regulatory approvals across 160 countries, and an existing 10 million subscriber installed base with the trajectory Starlink currently has. The gap between Starlink and the field is measured in years, not months, and it is widening as Starlink adds subscribers faster than competitors can launch satellites. The AI and orbital data center angle, the wildcard in Barron's thesis. Beyond Starlink, Barron is also extremely bullish on SpaceX's artificial intelligence division and specifically on what he describes as the orbital data center opportunity. In February 2026, SpaceX completed its acquisition of xAI, Elon Musk's AI company, in an all-stock deal that combined the two entities and added the Grok intelligence platform, the Colossus supercomputer, and a potential future chip manufacturing facility to SpaceX's portfolio. The orbital data center concept is exactly what it sounds like. Computing infrastructure launched into orbit, operating in the vacuum of space, potentially powered by continuous solar exposure, and connected to the Starlink network for global data distribution. Musk has argued that orbital data centers have efficiency advantages over ground-based facilities related to heat dissipation, power availability, and physical footprint. Barron has cited the potential for SpaceX to launch initial orbital data center capacity as early as 2027. The scale of capital SpaceX is committing to this vision is striking. The company's capital expenditures in the first quarter of 2026 alone totaled $10.1 billion, more than double the same period a year earlier, with $7.7 billion of that going specifically to AI infrastructure. This is an enormous investment rate, and it is currently being funded almost entirely by Starlink's operating profits. The combination of Grok's approximately $3.2 billion in annual revenue with the xAI infrastructure burn rate creates a significant ongoing capital drain, one that represents both the potential upside of Barron's AI thesis and one of the clearest near-term financial risks. The honest risk assessment. What would have to go wrong? Barron is a serious investor making a serious case. That means the counterarguments deserve equally serious treatment, and several of them are significant. First, the ARPU problem. Barron's projection of 300 million Starlink subscribers generating $1 trillion in annual revenue implies an average revenue per user of approximately $3,300 annually. The current Starlink ARPU is approximately $1,000 per year for subscribers overall, and that figure has actually been declining as SpaceX expands into lower-income global markets. The IPO prospectus itself disclosed that average revenue per subscriber fell 18% between 2023 and 2025, even as the subscriber base quadrupled. To reach Barron's revenue target, ARPU would need to approximately triple from where it currently stands, which requires either dramatically higher pricing in premium enterprise, aviation, maritime, and government segments, or a fundamental shift in the subscriber mix away from consumer residential accounts. Both are plausible, but neither is guaranteed. Second, the competitive intensification timeline is real. Amazon's Kuiper, Blue Origin's Constellation, and the Chinese state-backed competitors are all accelerating. Starlink has a commanding lead today, but maintaining it as better-funded competitors reach operational scale will require SpaceX to continue investing aggressively, which means the capital requirements of the business remain very high for years to come. Third, the Starship dependency. Many of Barron's long-term projections, including the 100,000 satellite constellation and the orbital data centers, require Starship to become fully operational at high cadence and low cost. Starship has made extraordinary progress, with 11 full-stack test flights through 2025 and the Block 3 vehicle targeting its first flight in 2026. But the history of spaceflight development suggests that large, complex vehicle programs regularly encounter delays and cost overruns that compress the financial projections built around their availability. Fourth, and perhaps most difficult to quantify, is the Elon Musk concentration risk. SpaceX's entire narrative, its culture, its ability to attract elite engineering talent, and its relationship with government clients are deeply intertwined with Musk's personal reputation and focus. Simultaneously running SpaceX, Tesla, xAI, and his various other ventures, while also being the most politically divisive business figure in the United States, creates risks that are genuinely hard to price. Barron has publicly acknowledged that he does not believe anyone like Musk will ever exist again. That level of founder dependency is a meaningful two-edged sword. Extraordinary upside potential paired with single point of failure risk that no diversification strategy can fully address. And finally, the valuation itself. At $2 trillion in market capitalization on approximately $18.7 billion in 2025 revenue and a net loss of approximately $5 billion, SpaceX is trading at over 100 times revenue. This is not a valuation multiple that traditional financial analysis supports. It is a pure bet on a future that has to materialize at enormous scale for the current price to be justified by fundamentals rather than by narrative. What different types of investors should take from this? Barron's prediction is not one-size-fits-all financial advice. Depending on who you are and where you are in your financial life, it deserves very different responses. For a young investor with a 20-plus year time horizon, a high-risk tolerance, and a portfolio that is already broadly diversified, SpaceX as a small, speculative position is a reasonable expression of a long-term thesis about satellite internet, launch dominance, and the commercial space economy. If Barron is even half right, the returns would be exceptional. If he is wrong by 50%, a small position in a diversified portfolio is survivable. For an investor approaching retirement, or for anyone who would genuinely feel distress if their SpaceX position dropped 30 to 50% from purchase price within the first 12 months, which the early trading history suggests is entirely possible. The risk profile of this stock at current valuations does not match a conservative financial plan. Great company, potentially transformative technology, real proven revenue growth. None of that changes the fact that the current market cap requires almost everything to go right for a long time before it is justified by traditional valuation frameworks. For the investor who bought near the post-IPO peak above $200 per share and is now looking at a price in the $150 range, that is a 30+% drawdown from peak in a matter of weeks. The question is whether you bought with conviction and a long-time horizon, in which case the business case is unchanged, or whether you bought on momentum and now need to honestly assess whether your original thesis was investment-based or excitement-based. Barron himself is clear on how he holds this stock, with a decade-plus time horizon, with the conviction of someone who has read every word of the prospectus, and with a position that represents a significant portion of his fund's assets. He is not trading around the volatility. He is planted firmly and facing forward. Here is everything we covered in its most essential form. Ron Barron invested in SpaceX privately at $20 billion in 2017, generated over $13 billion in gains by the 2026 IPO, bought another billion at the IPO, and then predicted publicly that a $50,000 investment today could become $500,000 to $1.5 million in 10 years. His thesis rests on three pillars: Starlink reaching 300 million subscribers and $1 trillion in revenue, the Orbital AI data center becoming a viable and scalable infrastructure business, and Elon Musk's singular vision and execution capability continuing to compound across all of it. The risks are real. Declining ARPU trends, rising competition, Starship execution dependency, the Musk concentration factor, and a current valuation that leaves almost no margin for error if growth slows. Barron has earned the right to be taken seriously, and the business fundamentals of Starlink in particular are genuinely impressive. But whether a $50,000 investment becomes $500,000 or $1.5 million in a decade depends on which version of the future actually shows up. And nobody, not even Ron Barron, can tell you that with certainty. What they can tell you is that the company is real, the revenue is real, the growth is real, and the lead is real. Everything after that is a question of conviction, time horizon, and how much volatility you can handle on the way to finding out if Barron is right. Drop a comment below and tell me, are you long on SpaceX or watching from the sidelines? I read every single one. And if this breakdown gave you real clarity on the Ron Barron thesis, hit that like button, subscribe, and share this with someone who is trying to make sense of whether SpaceX belongs in their portfolio. I am Warren, and I will see you in the next one.